G'day everyone, welcome back to another episode of Spark Your Fire. I'm your host David Shih, and as always with me today is John Comino. How are you, mate?
Hi there, David. I'm very good. Sun's shining, property market's going up. Who could ask for more, right?
Oh, it's just cold, I think. I don't know why. Maybe just me, John, maybe just me. But I had to rug myself up the whole time for the last couple of days. It's just been absolutely freezing in Sydney. Are you feeling the same, or are you actually in Sydney?
I'm in Sydney. Look, your approach of rugging up is a healthier approach. What I do is I dress lightly and I put all the heaters on in the house, and so I just have these beetroot red cheeks, which make me look like I'm I don't know, an alcoholic or something like that. But
that's the professional approach, John. Basically, that's the professional approach.
Yes.
Look, it's been cold, and I think it's been quite cold-hearted for quite a few property investors when they heard about the decision in June that RBA has decided to raise another 0.25%. I don't know how others felt, but certainly I think there's been a lot of disappointments, especially for those people who have had mortgages, because in April we've had a pause. May was already a surprise 0.25% rise, and then we basically got a double whammy again this month in June. So, it's a very tricky situation to navigate at the moment. I actually do think that I don't think anyone wants to see a high rate environment, in honesty, right now, right? But it's a necessary evil, because don't forget, the ultimate goal of what RBA is trying to achieve is to try to get that inflation down. Now, if I'm not mistaken, the goods inflation is reducing. It's going down. It's trending downwards. So that's the right path. But it's the services inflation, which is basically what the wages growth and all that kind of things. That's really what's worrying the RBA right now. So how do we get that controlled, and how easy is it to get that controlled? I don't know. I'm not an economist. John, you've probably got a much more sense than me in that. But I think the bottom line, reading the minutes from RBA this month, which just got released, I think, earlier today, the high interest rate environment is going to be here to stay, is my gut feeling. And what a change in the sentiment as well. Like we were talking about this off air as well. Previously, the bank's terminal rate was expected to be around a 3.6 or 3.85%. We've already gone past that. Today, the official RBA cash rate is 4.1%. We've surpassed that. And banks now new terminal cash rate is now expected to be around a 4.35 or 4.6%. Okay, so in other words, we might still have a few more rate rises to come. So there's gonna be a lot of pain to be felt. Is what I'm anticipating. But I don't know, John. What do you think? Do you think that is RBA a bit too aggressive on the approach here, in terms of having to consecutively raise rates? And did they give the wrong message back in April with the pause? Because that's what's kind of like, people thought that, hey, there was a pause and that should be the end of it. We're pretty much at the terminal right now. But then they fired again, and it's a double whammy. So it's very mixed messages. I don't know how you look at this, John.
Yeah. Couple of things in there, whether they made a mistake in April and so on, by pausing. The first thing is I think that central banks are often trying to manage the currency as much as they're trying to manage inflation, although they're largely the same thing, the weakness of your currency and inflation. So if the Fed puts up rates, they have to the RBA has to put up rates as well. Otherwise, then you're going to have a weakening Australian dollar. And so I think that there's a lot of currency management masquerading as inflation management, or masquerading as managing the growth in the economy. Really, they're kind of just managing parity with the in the currency markets. When they put interest rates up in June and in May again, both of them were moderate surprises, I think, as you correctly mentioned. And I think that I think that they're managing the currency, but also I think that they're trying to put out a fairly sort of strong, hairy-chested message to the market that we're going to do what it takes. We're going to do what it takes, and if you think we're done, think again. So I think that there's a bit of that. Whether they made a mistake pausing in April, I don't think they did. I actually think that the rate rises are the right thing to do, except they've done them too quickly.
Mm.
So I would have preferred a bit more intermittent pausing. So I would have preferred some rate rises, a pause. It's like having a big meal. I think you should pause before you go back up to the buffet table again. And I think that this is all going to backfire at some stage. Maybe it's 2024, but the rate rises have been too quick. So the pause in April, I think, was actually a good thing. It depends on what wording you accompany it with. If they said, look, we're going to continue raising rates, but we're just pausing so that we can get used to the new environment, that's probably the right thing to do. But I don't think the wording is ever that crisp, really.
No, and look, that's probably one of the key aspects with the new reform on what the RBA board will be, is talking about having that debrief straight after the interest rate decision, right? Because you got to have the RBA governor facing the crowd or explaining the rationale behind the decision, just like what the Fed does to a degree, right? They always have that explanation. So the communication can be done in a much timely fashion, and there will be a lot more clarity in terms of why that decision is made as well. So I think a lot of it comes down to communication, unfortunately, at the end of the day, whether it was setting the expectation that interest rates not going to rise until 2024, and then straight away there's 12 interest rate rises. We're not even in 2024 yet. So the
RBA is just playing follow the leader, though. They've got to do what the ECB, the Fed, and the Bank of Japan do. I mean, that's what they have to do. So this is why there weren't so many rate increases in 2018, even though lending dried up. It was because they were following the Fed, and the Fed were putting rates up back then, but they weren't putting them up meaningfully. So what had to happen then is, instead of rates going up, the regulators, APRA, had to come in and choke off lending. But we're just going to play follow the leader unless we want the Aussie dollar to go under 50 cents or 40 cents or whatever it is. That's what's happening. It's currency management.
So if I'm not mistaken, I think Fed has paused this month from memory. I think they did.
Yes, they did. They did.
Okay. Yeah. Okay. But they're still about a percentage or more higher than where we stand at the moment, right?
Yeah.
Okay.
I saw a very interesting statistic, and I can't remember where it was, but it was a bar chart of all the major economies. It had the UK, I think there were a couple of European countries in there, US, some major Asian countries as well. And it was the impact on serviceability of higher interest rates. And Australia was right up the top. So the impact of higher rates is really affecting mortgage borrowers in Australia. There's a lot of private debt, there's a lot of mortgage holders and so on. And the impact on the US mortgage holders was right down the bottom. It had barely increased despite all the interest rate increases. And the reason for that is US consumers have access to 30-year fixed loans. So they can raise rates until the cows come home. Most people fix their rates in over the last couple of years in the US. And so the US has a lot more room to maneuver before it really starts to impact average residential property investors.
Yeah, no, you're absolutely spot on, mate. I think that's one of the key differences. I can't even imagine a 30-year fixed rate loan, to be honest. I mean, we're struggling to even get 4 or 5 years, at that kind of low rates at that point in time. But we have a lot more people on variable rates, and that's how just traditionally how Australian banking system works, right? Yep. Most mortgages will be on variable rates, and therefore we are more prone to changes and fluctuations of cash rate in this instance. But look, John, let's step back a little bit. When is RBA? Okay, so let me ask this question then. I think everyone pretty much agrees that there could be a couple more rate rises to come. But even then, that doesn't really warrant the inflation going down. Okay, so the interesting part is, if they keep on increasing rates, something will probably break at some point in time. I don't know what it is, but I felt like a bit like US scenario where the Signature Bank and they're gone under, right? That's essentially, yes, that causes a bit of panic in the US market back at that time, but Fed continued on. Essentially, they obviously continue on their path. Do you think by going down with a few more rate rises, is something going to have to break, or something needs to be broken before RBA is going to say that's enough, we're going to have to stop?
That's yes. I think their goal is to some degree demand destruction. So they're going to raise rates until all of the currency units are being pulled away from discretionary spending, and that hasn't happened yet. But I think that they do it until something breaks. One thing to note, that the inflation rate is coming down very, very quickly. So the last two inflation reads out of the US. So inflation is now 4%, but they were expecting it to be about 4.2, I think, or 4.3%. So the last two prints, inflation has come in lower than expected. The next time it gets reported, it'll be under 4%. It'll be 3 point something. Now they want to get it to 2%, but we're getting there very quickly. So they either wait for an event, another Signature Bank or something bigger than that, obviously. A big corporate failure, or they stop when we get to 2%, which is probably not that far away, although it'd be more than a year. Now, to speculate what might break is perhaps a little bit more interesting, because all economists are saying, I think JP Morgan and all the big US banks are saying the chances of a recession in the second half of the year are like 100%. So what does that mean? And what do they think is going to break? And the not so subtle or not so secret view of a lot of these economists is that the straw that breaks the camel's back is commercial real estate. And that ties into the cost of holding commercial real estate is going up, like everything, via the interest rates. The values are coming down, but it's tied into working from home. So all of these big office blocks in New York City, Sydney, LA, London, they're empty, or they're at least half full. And repurposing them to residential, you've got to redo the plumbing and all that. It's very expensive. So not all aspects of commercial real estate are in trouble. Warehousing, for example, is fine. But office space is potentially a massive problem. And when all of these leases start to come up and you can't find tenants, or you can find tenants, but they only want 25% of the space because everyone works from home now. Commercial real estate is the thing to look at.
Okay. Now that's an interesting thought. I guess keeping in mind that a lot of employers are asking employees to come back to work full-time, and that's why I think we're starting to see, especially the rental surges around the inner CBD areas or closer to CBD, whereas the rents are starting to drop towards the regional areas, because less employees are able to have luxury to be able to work from home as much as they want as previously. I do agree. Yes, there will be, obviously not everyone's going to come back to work in the office full time like pre-COVID, but to the extent of how much is going to damage the office spaces or the commercial property area, we'll see what the data tells us moving forward. But I do agree with you. I think, I don't know what it is, but I do. My gut feeling is something's going to have to break pretty significantly in order for RBA to kind of put the stop. They're on a very aggressive part at the moment. All basically, like you said, the signal is we'll do everything to get inflation down to the 2 to 3% range by 2025, basically. So that's the trajectory.
Just to sort of put a ribbon on this as well, I don't think this is the 1970s, early 1980s, and I think there's a sense that every time you get inflation, it must be the 70s again, stagflation. And this is not what's happening. I think that inflation will come down very, very quickly in a way that it didn't in the 70s and 80s. And the reason for that is mainly demographic. So you had all of the baby boomers hitting 30 in the late 70s, right? So that's peak family formation. That's peak buying a house. Everyone got married younger then and all that sort of stuff. The baby boomers are like this bowling ball moving through a hose, and they hit peak consumption peak earning in the 70s and 80s, right? So that's not what's happening. In fact, we've got the opposite problem. We don't have enough workers. We've got a lot of retirees, and all those sorts of. So I don't think at all this is the 1970s. Grant Cardone, the famous and sometimes obnoxious property guru in the US, is very interesting to listen to, actually, and he gets a lot of things right. He says that in 6 to 12 months, we'll be begging for inflation.
So we're going to go into deflation, basically.
Yeah, that's what he's saying, that they've
gone too far,
cut too hard, and we don't have the demographics to carry kind of higher spending and all those other things that push prices up. So that's one way to look at it.
Okay, all right. Well, I guess we'll find out in the next quarter's information data coming out, and whether Australia is going to follow the path of New Zealand going into a technical recession, which I think they just did. And it's gone into a technical recession with two negative GDPs across 2 quarters. We will have to see. It is a narrow path, as they say. It's a very narrow path to be walking on. Need to be treaded very carefully.
Yeah.
But having said that, house prices are still a bit of a concern at the moment. I think it's also being mentioned in the minutes as well. The property prices, especially in the last month or two, has been trending very, very strongly. We're looking at an average capital growth of across all the capitals around 1%. Sydney, Melbourne, Brisbane in particular have been performing really, really stellar. We're looking at even closer to 2% in some of those instances. But yeah, do you think this trend is going to continue though, John? What do you reckon? Knowing, so look, every month when the rate keeps on going up, that always gives us a bit more, I guess, a bit more reason to look at what we think and how this market is going to be looking. And perhaps you can share with us in terms of what you're currently seeing and feeling on the ground. Are you seeing a slowdown in terms of buyer offers? Are they getting a bit more hesitant because of the latest increase in June rate rise? Or are they still going all in at the moment? Say, if I want a property, I want a property. What do you think?
So 2 questions. Why is it rising, that sort of thing? And then what am I seeing on the ground? So I think that what we've seen since 2008, maybe since 2000, is just a series of V-shaped. So a lot of volatility in the property market, because I think interest rates adjust more quickly with activist central banking, I would call it. So we've got these V-shaped recovery. So 2018, the market goes down 15%, and then goes back up into 2019 and 2020. And you just have these rolling V-shaped recoveries. But it actually the trend line is probably the same as it's always been. We're getting 6 or 7% capital growth over time. You just got to ride out the decline.
But nothing new there, basically.
Yeah. Let's say in a year, we're back at the peaks we saw in 2021. Let's say early next year or mid next year, we're back at those levels. We will also but there'll be a difference. We will be in an economy where prices are the same, but rents are now, let's say, 25% higher than they were back in 2021. So I think a couple of things have changed. One is that real estate did get quite cheap. It got cheap in relation to rents. So rents have gone up much higher. And I think that because of all sorts of supply chain issues, it's hard to build new properties when you've got high inflation and the cost of building has gone up. So I think it's a very good time to be in real estate, actually. I can really see it's a bit sort of clogged up at the moment. There's not enough properties. There's nothing coming on the market. There's a lot of reasons not to develop or build, or because that's all a bit difficult. And then you've got people flooding into the country. So that I think that equation is occurring to people now. In terms of what I'm seeing things move a lot more quickly. Vendor expectations are quite low still, and that's starting to change. So vendors are putting their properties on the market. They're a bit pessimistic, but they're looking at the sales around them during the sales campaign and realizing that maybe their expectations should be a bit higher. But one thing that's really clear is that fixer-uppers are not in demand. Fixer-uppers are materially and significantly priced below everything else in the market. And one thing that's interesting is there are some boom markets where people love fixer-up, and fixer-uppers are selling at the same price as renovated properties. That is not the case now.
I think that was the case about 2 years ago when everyone's gone into that FOMO mode, right? Even the fixer-uppers are going at crazy prices or flying out the door at crazy prices. But yeah, no, that is interesting in terms of what you're seeing. Is the differences in terms of that vendor expectation in the houses market or the unit market, do you reckon?
I mean, I'm in the housing market more at the moment than the unit market, but I assume that the expectations are similar. Yeah.
Okay. Yeah. No, it's definitely, I think, something that to watch out for. But yeah, I do. I think I'm in agreement with you in terms of the days on market is definitely dropping. The properties are selling at a faster rate at the moment. Depending on where you're looking at, I guess, and we look at different areas in Sydney as well. But I think the inner west and anything within like a 15-kilometer radius is still very much in demand right now. Therefore pushing that prices up. And don't forget, in terms of the number of stock, we're currently trending about 28% below than what we had previously. So that's where's the demand? I think the demand is still close to the 5-year average at the moment. So in other words, your demand is pretty much on average, but the stock is about 20% or even close to 30% short. So naturally there will be a lot more competition going on. And we're currently in winter, so it's a quiet period as well. So doesn't quite help.
One thing actually that I get wrong, I think a lot of people get wrong, is it feels like a boom time in the real estate market frequently. So 2021, a big bubble. I don't think it was a big bubble in 2021. I think the way you can distinguish from the big 2008 bubbles versus the smaller bull markets in real estate is the big like once in a 20 or 30 year bubbles, the 2007, 2008 bubbles. They're always accompanied by an explosion in supply. So supply levels are very high. What we have now is not a booming real estate market. Supply levels are very, very low. So I think always be sort of conscious of like what type of rising market are we in. But because the period leading up to 2008 is a period of excess supply going at very high prices. Whereas now we have a very low, we don't have very high demand. It's just that there's nothing to buy.
There's nothing to buy. I think that's what's really been driving the upwards pressure at the moment. It's because of that competition, right? As soon as there's more supply coming in, which, we also talked about this, whether we think that there's going to be more supply coming in later on this year or early next year, as more fixed rate, more, people coming off the fixed rate mortgages. Would that be more sellers coming in, which means potentially a bit more supply in that sense from the stock perspective? That could have an impact and weighing into how the second half of this year is going to pan out later on. So actually, speaking of that, John, what do you think? Do you reckon there will be more stocks coming up later this year because people rolling off fixed rate mortgages will look at, it's going to now cost me another $1,000 to $2,000 to hold on to this property. I'm not going to do that. I'm already struggling, with all the rising costs of everything. I'm just going to put that into the market. So do you think that's going to be the case where we're going to see an increase in terms of the supply numbers?
No. So my default answer to anything involving the word cliff is that I don't believe it. And I know that's not science. It's just what do they call it? I'm skeptical. I don't think so. I think for a couple of reasons. Actually, these cliffs don't all happen on the one day or in the 1 month. These mortgage cliffs actually transpire over a couple of years. So some people, it is going to be more heavily skewed to late this year, early next year. But how much debt do most people have? I think most people have one house. I think those people are going to struggle if they bought in the last couple of years. So I don't think that there won't be any pain. But do I think that they're going to therefore sell their property? No, I think a small proportion will do that. So no, I don't think so. I think this is a fallacy that a lot of people are assuming that there'll just be this flood of distressed properties on the market. That I don't think will happen.
Okay. I'm probably going to hold a different view to you this time, John. I
Yeah,
mean, I think
yeah.
it's good. It's good to have a different view, I think,
Yeah.
to a degree.
Of course.
I don't think there will be a flood. Look, I don't think there will be a flood of properties coming on, but there will certainly be a bit more stock than what we're seeing right now. I think maybe if I rephrase it that way. So we're not going to see distressed properties upright in the center, right? There's just going to be more people who, and depends on how deep the pockets are, which we're seeing, I think, based on the latest numbers, the savings, people are already dipping into their savings at the moment. How long can they hold on to it? How quickly can the rates go down potentially in 20? Is it going to go down in 2024? If it's not going to go down until end of 2024, I think a lot of people are going to have to force sell. Now that's when the disaster is really going to happen. But if this high rate environment is only going to be temporary, then no, we're only going to see probably a little short uptick of the supplies as we move into the spring season. And then hopefully move into more of an equilibrium side of market where the supply and the demand kind of meets in the middle, right? So I think there is a lot of parameters at play or variables at play here. But if I put my conservative or a bit of a pessimism type of hat on, in the worst case that RBA cannot get the inflation under control quickly, which we have seen at the moment, it's, like your assumption plays on the bet that at the moment it's going down very, very quickly. And, it is probably right. But in the worst case that if they can't get services inflation under control in the period they want it to, which means inflation stays sticky, which means the high interest rate environment is going to remain as is. And we might be looking at another 0.5%. So we're looking at 4.6% cash rate potentially for 1 year. For 1 year, how much damage is that going to cause to the households? And look, I do agree with you. Only 1/3 of the Australian properties have a mortgage. So it might not translate to that much. Yeah, or even, yeah. So it might not translate to that much of a damage. But, in comparison to, I guess, not everyone have to sell, but there will still be a bit more property or investors who acquired a lot of properties, including you and me, to a degree. We are probably the one that gets impacted the most every time when the rate goes up, especially when you're on variable rate mortgages. We might look at to say, it's going to, like I mentioned before, it's going to cost me this much to hold on to this property. And that's a significant jump. You're talking about a 2% to a potentially a 6%. It's a great time to be selling because I'm still going to be able to take some profit out of it. Why not?
Yeah.
So, it's going to add. I mean, my view is it's going to add to the stock available. It's not going to be a flood of it, assuming that inflation is under control. However, if this high interest rate environment is going to pertain and persist for over a year, we will probably see a lot more distressed properties coming up.
Yeah. We'll see. I mean, I don't think investors. I'm just trying to lay the rental market into this equation because you can make, if you're in distress, you can make a property cash flow quite easily in this market. So I'm just thinking, if you're like an owner occupier, do you pop a tenant in there and you hang on to the property? I think that in a high rental environment, you can make things work. But I'm definitely open to the thesis. Like I understand what you're saying with the distress creeping in once the lower fixed term mortgages come off, and I think we'll just have to see. I think we'll just have to see.
Yeah. And I'm also thinking along the line of, like people thinking that, yes, they can increase the rent to cover for the mortgages, but the reality is the mortgages has gone up so much more than what the rent has gone up. So the net return on the property at the moment is actually very poor, very, very poor for residential properties. For residential properties. So that's one thing that people have to keep in mind when they go, it's going to be another $500 per month, like potentially to hold on to this property, or even more, right? That's when they obviously think about that. So, yeah. Anyway, well, I think we will keep that view open, and then we'll see how it turns out. Hopefully, there's no massive distress sellings as what we all anticipating. We don't think that's going to be happening, but I mean, speaking of selling conditions, it's actually not a bad timing to be selling at the moment, isn't it, John?
Well, there's no competition. I mean, everything that comes onto the market, it's like throwing a chip at Bondi Beach, right? All the seagulls. There's not a lot out there. I mean, underlying demand is down compared to last year, but supply is even lower. So but what the supply the low supply is telling us currently, at least, and these things change, is that there isn't any distress, or there isn't much distress. So, but things change. Is it a good time to sell? I don't know. Yeah.
You don't get commission by selling; you get commission by buying.
Yeah, I must confess. Yeah, that's right. Asking a buyer's agent if it's time to buy or sell, or. But I mean, my view is the timing decision. I'm terrible at timing. I don't even like the question, in a sense. I know we've chatted about this, and I think you feel the same way. It's like, okay, so now's not the right time. So what do you do? I'm going to wait, and I'm going to remain homeless until the right time to buy. I mean, what you do is you buy when the bank sees you in the most favorable light. That's the right time to buy, and you don't know when that's going to be, other than probably right now. But it's really because there's so much debt involved in real estate, and because the bank is only interested in you for 30 years. Once you get into your sort of 40s and 50s, the bank's not really that interested in you anymore. So whether you like it or not, you have to start getting involved in real estate in your 20s and 30s, and to a lesser extent your 40s. So you buy when the bank likes you the most, and the prevailing market conditions may not cooperate with you, but that's, I mean, essentially it's a game of finance.
Right. That's what.
I know. What do you think of that?
As in terms of buying, timing of the buying.
Yeah, like timing the buying with your own finance rather than the market.
Oh, look, I totally agree. I think it just comes down to basically when you're able to purchase, rather than looking at whether it's the right time to purchase. Basically, right. Yeah. So that principle, I absolutely agree. But do you think it's how do first time investors looking at getting into the market at the moment? As you know, it's a very difficult situation to be getting in right now. You got very little stock, you got a lot of competition, you got finance, you got all these high interest rates at the moment, which there's a lot of headwinds to go against. Give us a few tips in terms of how the first time investors or first home buyers wanting to get into the market, what can they do to try to help them?
I'll give you I mean, I will throw it back to you because I think in terms of finance, that's a big component of what you're able to do. But I'd say a couple of things. Firstly, just be realistic with your budget. I would say prioritize a good location over a house. I think one thing that people get, they cling on to wanting a house. I think there are, if you're savvy, there are really good apartments in great areas. I think so. Don't be scared of buying an apartment in a good area rather than a house in a less desirable area. But I think that trade-off of land versus proximity, I think, is the thing that you have to answer. And I would say, as someone who's bought quite a lot of property, but also units closer in and houses further out, I'd say the units close in are really good investments. So there's nothing wrong with buying something a little bit closer, but that maybe is not the family house. I'd also say start as early as you can. The conditions are never going to be right. But yeah, those sort of three things are what I would say.
Good tips, I think. Look, I'll probably add on to that. Obviously, from finance perspective, make sure you've got your finance sorted, pre-approvals and that kind of things. And look, the banks are still in the game of lending at the moment. Obviously, that's how they make their money. So ultimately, they still want to lend. Although what I'm seeing now is they want to make sure, they don't want high risk lending in the current environment. That's what they penalize on. So anything that's like, don't even think about 6 times DTI, right? Like we're not even looking at anywhere close to 6 times debt to income ratio. So that's way behind us now. But anything over 80% LVR is probably being looked at a lot less favorable at the moment, and you're likely to get a lot more declines if you're not careful. Low LVR, so the ones that people who can come in with more than 20% deposit is being looked at favorably. Stable employment, that kind of stuff, generally speaking. So, it all circles back to, I guess, we only have limited working life, as John, you mentioned before. So, get in when you can, or not based on, do you think it's a good time or not to buy in that instance. So, but look, I think one thing that we do differ, just to make it a bit more controversial, John,
let's do it.
is even though we didn't talk about timing, I did ask you the question. Do you think that right now would still be a good time to enter? I'll explain my view. I think, like I mentioned, I think that ties back a little bit in terms of what I was saying previously. There would probably be a bit more stock available towards later or the second part of this year. If you are interested in getting into the market, right now is a good time to get your finance ready, okay? So you can actually be ready for the opportunity. But because the level of stock is still very, very low, so what you might see is, the first of all, the days on market is going to be very short. So you might not be able to see the property for the second time after the first inspection, depending on how the competition weighs out. Second thing, the sold price might be a lot higher than what you would expect. You go, I'm not going to be paying for that kind of price in today's market. So, and that's all because of the fact there is very little to no stock at the moment. When the stock level hopefully eases a bit more towards the end of the year, there will be a bit more opportunity for you to be able to get yourself ready. And, if you are ready from a finance perspective and obviously engage a good professional like, for example, John, to help you with your first property or investment property, you'll be on a roll. Like when the opportunity comes up, you can just pounce on it. That's kind of how you win in a market like this. A good opportunity is you only got that short window that you can get it. If you miss that window, it's going to be gone, essentially. So so that's my 2 cents. And look, I'll hand it over to you, John. I think you got the opposing view here to me. What do you think?
So I think that there will be more stock in spring, but that's seasonal, and that will definitely happen. The question is there more stock this spring compared to last spring or the spring before? And I think that we're going to be, and I think that no, I don't think there will be. I think we'll be in very tight supply.
Very tight supply continue on
in spring, because I think you have to compare spring to spring, not spring to winter. So yes, there'll be more available. Tom Panos, his weekly wrap, which is definitely worth looking out for every Saturday afternoon. He goes through how many properties sold,
auctions and all that.
And he's just a guru anyway. He said that the question he gets asked the most, this is on Saturday, the question he gets asked the most is now the right time to buy, which is essentially what we're talking about now. And he said his conclusion was you should wait a month or two. Now, my view is that assumes clairvoyance that no one has, like an ability to see into the future that's not possible. So I don't agree with the wait, but I never agree with the let's wait, because I think that it's sort of procrastination masquerading as market analysis. I think you should just buy when you buy now. And if you screw up, you screw up. But just buy now and worry about the deal. Don't worry about the timing. Maybe if Buffett doesn't worry about the timing.
Maybe if I add to that, buy now but have a long-term hold view, then you can't go wrong, basically. So
I would, and one little footnote: buy now, have a long-term view, and pay off principal. So if you're deleveraging, you're de-risking yourself. So if you're paying off debt, that's the best way to de-risk.
Absolutely. I think, John, you in some sense you're a lot more conservative than me to a degree. My philosophy is always let the time do the payoff because of the inflation side of things. But I tend to err on the same side. I said, yes, you're probably right. Having a double safety measure is never a bad thing. So, all right, John, I think that's pretty much it. Anything else you want to cover?
We covered loads. No, nothing to add.
Okay. Nice chat as always. And thanks for joining me again. And listeners, thank you all for joining us again for another week. And look, we'll bring you a bit more updates in about 2 weeks' time, where we will have the fresh data coming up for July. Let's see whether the property pace is still continuing on the trend as we are at the moment. Otherwise, what we discussed today is general in nature. Again, if you are looking to do anything, please do check with your specific advisors. And until then, we will see you guys again in another episode of Spark Your Fire. Cheers. John and David. Bye.